Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back, and thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily Monday through Friday at 3 p.m. along with my co-host, Joe Kuchera and Laurie Graymont. If you can't make the live show, you can catch your podcast on RE360radio.com, and you can catch my programs, including this one today, on TomWilsonProperties.com or on iTunes. We have a great program, another great guest who's, I believe, the first time on the program, and Graham Parham, who's a 17-year experienced lender, specializes in investors and investor loans, and he's with W.J. Bradley Mortgage Capital in Dallas, but you may know the name W.J. Bradley Mortgage. He was very strong in California. We also have in studio with us today Richard Smith, who's a 40-year investor and 30-year accountant and enrolled agent, and that will help us with the dialogue of talking to Graham about the loans and loan programs and so forth. If you go to TomWilsonProperties.com, you can sign up for a newsletter that comes out once a week on the economics summary, a nice one-minute read written by an economist, friend of mine, who and that will give you a summary of how economics applies to real estate for that past week, so you don't have to read the entire Wall Street Journal to try to figure out what's going on. And at any time, we also have a report that tells you about ways and methodology of going through the process of selecting the best metro and selecting the best product to invest in. Nice 19-page report with lots of facts and data. And anytime you have questions or recommendations and suggestions for topics, please let us know. Again, TomWilsonProperties.com. So let's jump into it. Graham, it's nice to have you with us. We are having, I've had, Graham, you've probably done several hundred loans so I know several hundred between Richard and myself and our clients. And like I always tell my friends and listeners, the most important thing when you're selecting your team to get into an investment like real estate is to make sure that all of those people are specialized in the area that you're in. There's a big difference between someone who specializes, for example, a lender who specializes in investors and investment loans than a lender who just does loans mostly for owner occupants. So Graham stays on top of this aspect, and the majority of his business over the years has been working with investors. So Graham, welcome to the program.
Thank you, Tom. Appreciate you having me.
How are we doing with ice storms down there in Dallas? Have we passed that?
Well, we're about 65 today, so it looks like most of it's melted off, and we got sunny skies, and I'm hoping it's going to stay that way until I jump my plane to head to Mexico on Friday, so it won't really matter after that.
There you go. You going to do some diving down there?
Yes, sir, I am.
Good. Take a dive for me, okay?
Thank you, I will.
Okay. Graham, tell us a little bit about yourself and W.J. Bradley Mortgage Capital, LLC.
Well, as you mentioned, Tom, I've been in the business for roughly 17 years. Had the privilege of working with some of the larger lending institutions from WAMU to, all the way to W.J. Bradley. Haven't really experienced the broker side of the equation, but mainly working with correspondent lenders and large banks. And I guess Richard was probably one of the individuals who kind of pigeonholed me into the investor side of the business. And one day I woke up and probably 90% of my volume was working with investors, and it's been a pleasure ever since. And that's been about 2000. And I love working with investors because they're no muss, no fuss. They want to get the job done, and they're looking for somebody to give them some knowledge and experience to get down to the finish line on time.
Sometimes we do several loans at once, right?
Yes, sir, we do. Yes, sir, we do. The thing about W.J. Bradley is that we have the capacity to do multiple loans at one time. The company itself, we were founded in 2002 by a gentleman named Bill Bradley. We're based out of Denver, Colorado. As far as the capacity of our company, we have two processing centers, one in Denver and one in Salt Lake. We're represented in about 22 states. Our ranking, which is through the Scotsman Guide, which is one of our leading industry publications, which measures the loan originators. In 2012, we probably were ranked right around 8, but we had a large acquisition in 2013. If we had those numbers in there, we'd probably be closer to 4. But as far as the overall volume, we'll probably end up doing close to $7 billion this year in loan originations, and we are privately held. The company itself, we do probably close to 100% of our loans that we originate, we do service, and we sell primarily to Fannie and Freddie.
Graham, explain to our listeners what a correspondent lender is.
Well, before the meltdown, I guess in 2008, probably 70% of the originating pie was loan brokers. Okay, brokers are represented. A lot of states didn't even have licensing requirements for brokers. I mean, they could have their own shop set up. They could have several originators there, have their own processing there, but ultimately they would send their loans across town or out of state to the bigger banks, typically at that time, where like a Wells Fargo or Bank of America or Chase, their processing would then acquire the loan, process the loan, fund the loan in their name, where the broker would not have any skin in the game, so it never would be closed in their legal entity. The correspondent lenders, or we refer to as mortgage bankers, typically have large lines of credit that they use for their asset base. They will originate the loan, underwrite the loan, and close the loan in their name. And then once they close the loan, they typically sell those loans off into the secondary market, whether it be back to one of the aggregators, which would have been a Wells Fargo or a Chase. And if they did that, they would have to underwrite the loan in accordance to their guidelines, or sell them, directly to Fannie or Freddie, which would be underwritten in accordance to their guidelines. Many lenders have their own overlays, which is their level of risk. We have very few overlays in our guidelines, which makes lending a lot easier. Really does.
So let's talk about the number of loans that are allowed. I think most investors are familiar with, but maybe some listeners are not, how we went from no limit to 4 and to 10. And let's talk about that and what kind of loans are available today for investors.
Well, to give you a quick history, before the 2008 meltdown, Fannie and Freddie allowed for borrowers to go up to 10. And beyond that, we relied on alternate A lenders, which was mainly the New York-based institutions, would allow for additional loans over and beyond that, and which had no limitations. When the mortgage meltdown hit back in 2008, then, of course, the Alt-A paper, which is the entities that we're referring to, they're one of the first to leave the playing field. So needless to say, we're back into the Fannie-Freddie bucket, and at that point, they decided to have a knee-jerk reaction and cut their limitations from 10 back to 4. Probably 10 months, 11 months later, Fannie said, okay, well, let's take it back to 10. Unfortunately, Freddie Mac never followed. So today, to answer your question, since we deliver most of our loans to Fannie Mae, we can take a borrower up to 10 loans, but no greater than.
And different entities don't make any difference. Has to be personal guarantee behind it, right? Or
we have to underwrite the individual. We can't underwrite a corporation. In other words, we can't do an LLC, S corp, anything other than an individual. But we also do them in a family trust, and it has to be a revocable trust. We will do it in that.
Mm-hmm. Okay.
Graham, does that mean you could have 10 for the husband and 10 for the wife, possibly?
Richard, that's a great question, and that's one of the things that originators have tried to accomplish over the years, and even giving direction in that area. to the point where the lenders started figuring out, okay, the borrower, which say is the husband, I'm going to go get 10, and when I'm done, I'm going to let my wife go get 10. And let's say the husband had enough income to support acquiring 10, and so did the wife. And that's okay if you can prove that on paper, but typically one of the things that the lenders don't instruct these individuals about is that they'll try to title the loans in both the husband and wife's name, which will ultimately end up on Schedule E of the tax returns. So when we look at the Schedule E of the tax returns and we see 20 loans on there, or let's say 12 loans on there, we want to know how many is his, how many is hers, and how many is theirs. So we will have to prove that as well.
Thank you.
So you got to be careful how you title them, right?
Exactly.
Yeah. So let's talk about DTI and what's the maximum a borrower can use.
The maximum DTI today, which is the debt-to-income ratio, it's kind of a moving target. It depends on the strength of the borrower, and also depends on the underwriting engine, whether it be a underwriting engine that's sponsored by Fannie Mae or the one sponsored by Freddie Mac. We do the bulk of our loans through Fannie Mae, and typically a borrower that has very strong assets and very good credit, a lot of times we'll allow those DTIs to push beyond the quote 45%, which is where I like to hold the threshold, to maybe 48, 49, 50%. It just depends. The desktop underwriting engine just had a recent change in November where I really haven't had a chance to push that envelope like in those situations to know if they still will allow for that. But I know a lot that's going to be changed in January. They're going to try to throttle all the entities and all the guidelines back to 43%. So that's still kind of up in the air right now on how that's going to play out. Just stay tuned to your news channel. It'll always change on you.
Okay. How well does it work? How do you handle more than one loan going at a time?
You mean if a borrower's trying to buy like 2 or 3 at a time?
Yep.
Good question. Typically, if an individual can qualify for one, they typically can qualify for the 2 and 3. And the way we do it, there's a thing called seasoning and non-seasoning landlord. If you're a seasoned landlord, we're going to give you full income on properties 2 and 3 when you're buying it. And if you're a non-seasoned landlord, we will give you up to, but no greater than, the principal and interest, tax, and insurance. So let me just kind of put that into layman's terms. Let's say you have a $100,000.
Graham, if you will, excuse me. We need to take a short break. Let's continue that as soon as we get back. So
Okay.
Graham's going to talk to us as soon as we return about how he handles multiple loans for multiple properties that a investor is handling at one time. We have Graham Parham with us with W.J. Bradley Mortgage Capital, and he's sharing with his experience and working mostly with investors over the years. This is Real Estate 360, KDOW 1220 AM, the Wall Street Business Network. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have Graham Parham on the line with us today from his Dallas office with W.J. Bradley Mortgage Capital. 17 years experience and a true investor's lender. And also in studio today, Richard Smith, someone who's been associated with both of us for many years for handling our taxes and tax questions. Graham, before the break, we were talking about the different seasoning and how that affects what income you can use on an application. So that's the kind of thing that a lender who deals mostly with owner-occupants probably hasn't got a clue. Go ahead.
Well, one of the things that consumers just don't understand is if you can buy and afford one rental property, then chances are you can buy and afford 2 and 3 at the same time, because there is going to be some income that's going to be given back to them. And that's, I've had that question asked many, many times. Well, how many can I afford? And that's the answer that I give them. What we do is, if they're buying, say, 3 at a time, we're going to give them income back on properties 2 and 3, whether it be if we can show that there's a tenant in the property that they're buying, or proven with a lease agreement, and or if we get rental comps from the appraisers showing this property will rent for this, this average amount of money per month.
So notice listeners that there's a real value in getting a property that you can have leased and show that there's a lease agreement on. Right?
Correct. That's the best way. Okay, so just for round figures, there's a kind of a mathematical formula that we use for seasonal buyers and non-seasonal buyers, and we'll talk about the differences of that in just a moment. But as far as the seasonal buyers, and that's in our minds, that's at least 12 months or more. Before, say, 6 months ago, we had them at 24 months, and you'll see with most lenders, they view it the same way at the 24 months. And what that means is that you can prove that you've had rental properties for that length of time. So for a seasoned landlord, if they're buying, say, a $100,000 property, and they don't have a tenant in it, okay, as an example, we're going to give them 75% of what the appraisal average market rental value will give them. And typically, if they buy right, then typically they're going to get around close to 1% of the rentals back or higher. So if you buy a $100,000 property, you got a $1,000 rent coming in, we're going to give you 75% of that. So now we're down to $750. The principal, interest, tax, and insurances that is going to be on the particular property that you're buying adds up to $700. Well, we take the $700 from the $750. Now we have a positive income of $50 that's given back to the buyer once he acquires all 3 properties. So it's kind of a wash for all practical purposes.
Well, certainly if you have less than a year or 2 of experience, it's a lot easier to qualify for buying 6 properties that are leased than there are 6 properties that are vacant and need to be rehabbed, and will be some time before they have income coming in.
Correct.
Yep. Okay. Let's talk about where a borrower can get his down payment.
Well, typically, we'd like to see it from their own funds. People that have acquired, their own primary residence over the years, they've gotten a gift from their parents or wherever. Gift funds are not allowed for investment property. It does have to come from their own source of money. We do prove their bank statements for at least 60 days or 2 cycles of bank statements, and we do take a look at any large deposits. And if a guy has an average balance of $50,000 in there and there's a $30,000 deposit, we want to source that deposit, make sure it's not coming from mom or dad. So if you have an example of an individual that just graduated college and mom and dad says, hey, you need to start investing into real estate, great. We're going to help you out with the first couple, so we're going to give you $30,000. No problem. But that $30,000 has to sit in a bank account for at least 60 days or more, so it's going to be considered seasoned funds.
Okay. Go ahead.
That's one way of approaching. Another way of approaching, which a lot of buyers were taking advantage of back before the meltdown, is they were tapping into the equity of their homes.
HELOC.
HELOC, exactly. It's called home mortgage line of credit. But, with the rise and fall of appreciations these days and the values of homes, a lot of those HELOCs are not as popular as they used to be, but we will honor those as well if an individual still has, some equity in their house. And,
of course, a lot of our clients come from California, and the areas like Bay Area have come back in value. So now I think, that's a reasonable source again. And, of course, we'll also talk about maybe IRAs and self-directed here in a moment. As soon as we get back from the break, we've got Graham Parham with us, calling in from Dallas, and Richard Smith in the studio, talking today about loans for investors. This is KDOW, 1220 AM, the Wall Street Business Network. This is Tom Wilson with Real Estate 360. Stay with us. We'll continue in just a moment.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have Graham Parham in Dallas with W.J. Bradley Mortgage Capital talking to us about investors' loans, which can be quite different than owner-occupant loans. And also Richard Smith in the studio here. Let's continue with talked about HELOCs now as something that's viable again for people to utilize, certainly in San Francisco Bay Area and coastal cities where that have come back quite a bit in recovery. How about IRA money while we're talking about sourcing or funding properties, Graham? That's something you can support.
I can direct you to institutions that do that. Unfortunately, I'm straight Fannie Mae, Freddie Mac, which they don't do the IRAs because they're tricky loans. Because the IRA is the controller of the property. They have to set up an LLC within that IRA. And then, of course, once you buy and sell the property, the money goes back into the IRA. So we personally don't do that. We're strictly Fannie Mae and Freddie Mac.
But it isn't uncommon for some of our clients to say, well, I want to do one there, and I want to do two of them just outside of that.
Yeah,
so,
it's very popular, and a lot of people take advantage of it. The underwriting's a little different. The terms aren't as good as the Fannie and Freddie products. Right. A little bit more aggressive on the down pays, but it's still a viable option.
LLCs, can they be used, or you have to transfer title after you close?
Well, in the Fannie Mae Freddie Mac world, they do not allow for entity vesting, which is we discussed earlier about funding it into an S corp, an LLC, a limited partnership. Once the loan is funded, it's in the individual's name. If the individual wants to retitle it, unfortunately, nobody has control of it but them. Although all these notes that we have are promulgated notes, which do have a clause in there which is called due on sale. And they can't easily call that note. I do know, Tom, that a lot of the investors that you and I have worked with over the years will exercise that ability to retitle it into an entity. I've never seen a note called, except for if they stop making payment on it, but it's something I can, not personally advocate being a mortgage lender.
Right. But my practical experience from talking to friends, clients, associates, peers is that it's rarely exercised. You just need to know that, if by chance it did, you got to have a backup plan for it.
Correct.
Let's see. What shall we chat about next? I guess maybe in the talk about how to qualify an investor. Now, I must say that it's pretty rare that we bring you a client who wants to buy products there in DFW that you aren't able to qualify. But talk a little bit about the qualification requirements.
Well, typically I like to have a preliminary conversation with them up front, kind of get an idea of what their objectives are, what they think their credit profile is, kind of get a general idea of what their income is and what kind of assets they potentially have, as well as what kind of liabilities. And if I kind of get a gut feel that everything's a green light, I'll direct them to my website to do an online application, or I can take the application over the phone. A lot of people, especially in the California and the Silicon markets, they love to do the online thing, so that's pretty much the majority of them. Once I get the application in-house, then we take a snapshot of three categories: your credit, earnings, and assets, mainly from what the information was provided to us from the application. And if all those line up, then we're pretty much good to go. At that point, it's just authenticating the asset and income information through like tax returns, pay stubs, bank statements, and this type of thing. But we do like to go through that exercise before we redirect them back to you, Tom, because you want to make sure you have a qualified buyer and you don't, hang up one of your contracts for any length of time.
We don't want to spin anybody's wheels. All right, let's continue the process part of it and qualifications as soon as we get back from this short break. This is Real Estate 360, KDOW 1220 AM, Wall Street Business Network. We have Graham Parham with us in from Dallas and Richard Smith in the studio. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
We're getting great information today from a very experienced investors lender, Graham Parham, who's talking to us from Dallas, and we have Richard Smith, our accountant and also experienced investor here in the studio with us, talking about the process and qualification, so forth, of an investor and what's available to them today. What kind of credit scores does the investor need, Graham?
We have them down as low as 620.
Holy smoke!
Wow.
You got to be kidding me.
Yeah.
No, 620 is the threshold. The thing about the credit scores, they're also measured for the interest rate because they have several breaks on credit scores of how good or bad your interest rate will be. And that's not that ugly. I mean, a normal 20% down interest rate today could be in your lower fives, where, they could push them up to the middle fives with, less than, say, 700 credit scores.
Wow.
But we will do them down to 620, but it's still dependent on the underwriting engine that approves them or not.
Does the ratio need to be better, I presume, if you're down at 620?
It couldn't hurt.
Okay. It depends. You're going to tell me that? It depends.
Well, you've got three categories you look at: your credit, how much you make, and how much money you have. So
Yep.
if you have a weak link in there,
Gotcha.
the other two better be strong.
Yep. Okay. Richard, you had a question for Graham?
Graham, the kind of discussion I'm having with my investor clients today, and first of all, let me thank you for all the loans you've done for me over the years. I don't know, 40 or 50. It was a real painless process, and I loved it. I can't get a loan today because I have too many loans from you. But the point is, when I'm talking to my clients today, a lot of them have had short sales and foreclosures over the last few years, and they're trying to get back, into the investment world. What's the current situation for someone who had a short sale or foreclosure, say 2 or 3 years ago? What chance might they have to either get back into it? What would you offer them?
Well, let's talk about all three. Let's talk about the bankruptcy, the foreclosure, and the short sale. And this is the part that I think is a little kind of crazy. But if you're doing a bankruptcy, or if you were involved in a bankruptcy, Chapter 7 or 11, you have a 4-year period that you have to wait before you can get back to doing loans. Although, if you have extenuating circumstances, which typically is medical, death-related, something that makes sense for an underwriter to override that rule, then they can do it as less than as 2 years. But now here's a hard stop.
Used to be 7, right? Used to be 7 years?
Not on the bankruptcy, no. But on the foreclosure, if it's a true foreclosure, it is a full 7 years.
Yep.
Mm-hmm.
So if you got a bankruptcy and you had a foreclosure involved, you're stuck at 7 years. Now, on the short sales, or a deed in lieu of foreclosure or pre-foreclosure short sale, it's 2 years minimum at an 80% loan to value or 20% down. 4 years if you're doing, less than 20% down. But as far as investment properties, 20% is the threshold. So you're looking at a minimum of 2 years.
Good. Thank you.
Okay.
Now, one other thing about the short sales, Dick, which you probably already know, is that whatever the delta difference was between what they settled for and what they sold it for, that's still going to come back and haunt them on their credit, and they're still responsible for that liability.
Well, California's got a special law on short sales where that amount of forgiveness of debt is not taxable. New law in California a couple of years ago, and it's open now. So we see a lot of relief, but we still have to deal with that cancellation of debt in their tax returns a lot. Thank you.
Mm-hmm. Graham, give some more examples, if you will, of rates and how much. Well, first of all, what's a typical delta today between an owner-occupant loan interest rate and an investor loan interest rate?
It usually averages about a half a point to 5/8. Some days are better than others. On a single family, with a 1 to 4 transaction, and what I mean by that is you have no more than 4 loans, and you're doing the 4th loan or less, you can do up to 20% down. Now, beyond that, when we do 25% down, you actually get a better rate. The way Fannie Mae
even if you already have 4.
Correct. There's certain hits that we refer to as, or certain rate adjustments that we have for Fannie Mae products, which the rate adjustment, and try not to put this into a mathematical equation, but it's like 3.25 hit for a 20% down, whereas on the 25% down, it's only like a 1.75 hit. So chances are on a 20% down, you're still in the lower fives, but you may end up having to pay a point origination. Whereas if you put a 25% down, you may drop that rate down another eighth of a point and waive that origination altogether.
Okay.
Now, as far as the product's concerned, Tom, I know that was something that you wanted to discuss. I mean, we're kind of down to the manila flavored. We have the 10, the 15, the 20, 25, and 30-year fixed rates. And we also still have the 5, 7, and 10-year ARMs. The ARMs are not as popular, needless to say, because of our rate environment. You know, why go for the ARMs where you can still get an affordable fixed-rate loans? Plus, the loan-to-values are lower on the ARMs, whereas they aren't on the fixed rates.
Okay. So give us a couple of examples there of how it varies between those types.
Well, like if you were to do a single-family residence, you have to put 30% down versus 20. Okay? And if you were to do a duplex to a fourplex, now you're down to 65%. And then when you fall into the 5 to 10 category, which is a straight Fannie Mae program, which we call multifamily program, on a single family, now we're down to a 40% down pay and a 45% down pay for a 2 to 4 unit. So the loan to values are much less, so it makes it easy for you to go with a fixed rate.
Okay. How's a 5-year ARM interest rate comparing to, say, a 30-year fixed today?
Once again, it's about, be honest with you, Tom, I don't have that information in front of me, but they have gotten a lot better than they have been over the years. Over the years, they were pretty much on top of each other, but there is a nice delta difference these days for the 5 and 10-year ARMs. Okay,
all right. When we come back right after this break, we'll chat for just a couple of minutes about the HARP and what's going on there. We have Graham Parham with us with W.J. Bradley in Dallas and Richard Smith in the studio. This is Tom Wilson with Real Estate 360 on KDOW AM 1220, your Wall Street Business Network, and we'll be back here in just a moment with Graham to talk about the about HARP.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Graham, welcome back, and welcome back guests. We've got Graham Parham from with W.J. Bradley, an investor's lender in Dallas with lots of experience, who's done a lot of loans for myself and for Richard Smith, who's here in the studio as well. Tell us about the HARP program briefly, Graham, please.
The HARP was designed back in 2009. President Obama came up with the Home Affordability Program. We're actually on HARP number 2. HARP 1 was fortunately not very successful. I think the HARP 2 has been very successful, but still has limitations to the point where the qualification to get that loan is that you have had to have closed on that particular loan before June of 2009, and it has to be owned or held by Fannie Mae or Freddie Mac. Rumors have it, and I've been seeing a lot of publications about coming out with HARP 3 sometime in the first quarter of next year, where they're going to take off the requirement for having it being owned by Fannie Mae or Freddie Mac, which is going to open a lot of doors for a lot of investors that may have had some old portfolio products that they can't get refinanced and they're wanting to. This can help them out. And then the great thing about the HARP program is that it doesn't have any limitations on the amount of loans that you already have on your portfolio.
Okay. One last question for you. Do investors still like buying investment properties in Dallas?
Absolutely. Absolutely.
If they can get a loan.
If they can get a loan, huh? Well, if they don't have too many, they can get. Actually, it's pretty easy, wouldn't you say, Graham, for them to get loans as long as they don't have more than 10.
Exactly.
Yep. Okay. Graham, it's been great having you with us. Do you have any kind of final comment, or at least tell us how people can get hold of you?
You can call my direct toll-free number, and that's at 855-543-5194. that's linked into my email. If you call me over the weekend, it'll send me a prompt, and I'll call you back anytime. But myself or any of my staff is more than willing to answer any of your questions.
And your website, Graham?
It's my name. It's www.grahamparham.com. That's GRAHAMPARHAM.com.
And I would say that Graham has been our prominent source of loans for Wilson Investment Properties for all the years we've been supplying turnkey quality investment properties to our investors. And he's certainly our number one choice because he understands the market and he closes. He gets the job done. He doesn't lead you astray if he really can't do the loan, and very knowledgeable. Graham, thanks for being on the program.
You're welcome.
Richard, thanks for being in the studio with us.
Thank you, Tom.
Again, if you want to have a 1-minute read once a week on what's going on in the world of economics and interest rates and so forth, you can go to TomWilsonProperties.com and sign up for that. Let us know your questions, suggestions for guests. You can ask for a report on how to choose the best metro and product. And it's certainly a lot of resources for investors on any of these websites that our team has, like Graham and ourselves and Richard Smith. So thank you for being with us today. It's been great having Graham and Richard here with us. A lot of very pertinent and critical information that the investor needs to know about. We invite you to come back next week to be with us with another guest on KDOW at 1220 a.m. The only thing that matters, remember, is what you do next. Thanks for being with us.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.